would have a negative real yield of -4 to 10% a year. Then if I borrow 100 billion, it has a positive real yield of +4 to 10% a year. So by being the borrower, I'm actually getting cheap capital. If my stock is appreciating at a rate of 14% a year, then I might as well borrow $100 billion and pay 4% interest, and then buy back 100 billion worth of my stock, which is 14% yield. And then I'm scraping 10% yield off of that, right? I mean, the 14 versus the 4. And I found a way to actually accrete $10 billion of value a year to my shareholders by taking on leverage. So the status quo for operating companies is, I don't want an endowment. I want a negative endowment, right? I don't want to retain capital. I want to distribute capital. If I can't reinvest it, I have to decapitalize and give it back.
Now let's take a look at the Bitcoin's option chain. Let's take a look at how the Bitcoin options market volatility implied move. To do so, let's check the ATM straddle of Bitcoin, which is currently trading around 27,000. Let's check the implied vol price by the market, and let's calculate the cost of an ATM straddle. To do so, just spot the midpoint of the call and the midpoint of the put to calculate the cost, and just do a quick ratio of the 27,000, and we see that there's an implied move of around 13% over the next 2 months. And the current cost to implement the position is around $3,500. So if we make a quick head check of what the move of $3,500, we see that the market is pricing a range-bound scenario with slightly more downside potential over the year end. Since most options expire worthless, this will give us a ballpark of the high-end expected volatility for the Bitcoin till the year end. And these are the ranges of the implied straddle if we put it in the chart. Is this a great opportunity to buy this straddle? Put in the comment section down below if you would buy the straddle or if you would rather sell it and capture the premium. And check the pinned comment for a very special Signal bonus, as Bybit is giving you free $20 just for creating an account so you can start trading real money within an hour.
The consequence of this is a bunch of highly indebted operating companies everywhere in the world. Even why would a company like Apple, which is the healthiest company in the world, why does it have so much debt? Why would you indebt a healthy company? Because if they don't take on the debt, it's dilutive to the shares. It's bad for the equity. Well, why is it that you have to actually decapitalize the company and take on negative capital or take on huge amounts of debt in order to avoid tanking your stock? And that's because of the monetary policy of the currency. So when the more inflationary the environment, the more important it is to be indebted. If you were in an environment like Argentina where you had hyperinflation, the only way you stay wealthy is to take on a huge loan in pesos when the peso is 20 to the dollar. And when the peso ends up 800 to the dollar, right, you pay back the loan in massively devalued pesos, right? So you get rich by getting in debt. So most companies are pretty intelligent. The CFOs are intelligent and they figured this out. But what's the problem? The problem is, A, they decapitalize by giving all the money back, so they don't have any capital. So if they run into a crisis like COVID, where the world shuts down, the cruise lines got shut down for a year. The hotels got shut down for a year. When you run into a crisis, you don't have any capital, and so you're undercapitalized and you may go bankrupt. That's the first problem. The second problem is, if you compound it with taking on debt, even if you don't run into a crisis, if you simply have a bad quarter where your cash flows are 20% less than they were the previous quarter, you're still making a ton of money, but you trip all your debt covenants and the debt comes due and you're insolvent. So, that's another massive risk. You're putting a totally healthy company at risk by loading it up with a ton of debt so that you might destroy it, even though your revenues could be off 2% from expectation and you could bankrupt the company. Marvel Comics, for example, was bankrupted because it carried too much debt, even though, people still love the comics. And so that's the second problem. The third problem is you're encouraged to do all these dilutive acquisitions. And in my experience in 30 years in business or 30 years running a public company, all of my competitors were destroyed or failed because they did bad acquisitions. The number one reason for software companies to fail is they did bad acquisitions. They bought companies for too much that weren't worth that much because they were desperate to buy something to support their own stock. And so, if I tell you, go out and buy something expensive by the end of the day, you've got till 5 o'clock and otherwise you lose all the money. You're running around and you walk into a Persian rug shop and you try to buy the Persian rug and the guy wants $80,000 for it. It's worth $4,000. And if you can wait for 3 days, you'll get it for $4,000, but you're bidding against yourself in a hurry. So you pay $42,000 for it. And you tell yourself it was a good deal because you were going to lose the $42,000 anyway. So the existing rules, they force everyone to make irrational decisions, take on debt they shouldn't take on, buy companies they shouldn't buy, issue dividends they shouldn't issue, and buy back shares they shouldn't buy back. And the significance of Bitcoin is in two ways. First of all, CFOs and CEOs starting in 2024 will now have the option to buy Bitcoin instead of buying treasury bonds. So now you can buy a commodity that's liquid and fungible on your balance sheet. And that commodity is a scarcity. And because it's a scarcity, that means you can expect it to accrete in value more than 7%, probably 14% a year over the long term, even after we've gotten through the bull run and after the early adoption boost, which will cause Bitcoin to appreciate at rates faster than 14%. In the long term, over the course of 100 years, starting a decade or 2 decades from now, you could expect it to appreciate at 14% a year if the money supply or the currency supply is appreciating at 7% a year or expanding at 7% a year. So you've got an asset which will appreciate in price versus fiat. And of course, bonds don't, right? Bonds never appreciate in price for the most part against fiat. You're buying them at par in order to get the taxable yield. So that's a big deal, right? It's not comparable to buying a portfolio of soybeans or silver or gold or oil or natural gas, because those are true commodities. And the problem with commodities, and Bitcoin doesn't have this problem. This is why people have to, we should really call it a scarcity rather than a commodity. The problem with commodities is there's a dysfunctional, systemic, endemic inflation built into the system. Not only is it possible for someone to create more oil, it is a certain thing that when the price of oil triples, they will create a lot more oil, and no one is concerned about keeping the supply of oil in check over the long term. There's this dysfunctional competition. You can try to create a cartel like OPEC, but people that aren't in the OPEC, like the frackers in Texas, they're not in OPEC, and they're going to frack oil, and they're going to bust that cartel. And all of these commodities find their cartels broken, and the gold miners want to produce more gold. The silver people want to produce more silver. Soybeans want to produce more soybeans. So commodities aren't scarce. And I want to distinguish between that kind of ungoverned inflation or dysfunctional inflation versus the governed inflation of equities. Apple Computer or any company in the S&P 500 can also issue more stock. And if you buy infinite amounts of the S&P index, you'll get a lot more stocks. They will issue more stocks during the height of the market boom in 2021, when you had GameStop and you had all the meme stocks. You saw all these people printing a lot of equity and selling it to the market. And that's the danger of those assets. But at the end of the day, Tim Cook doesn't want to print infinite Apple stock.
Quick reminder that if you want to know more about the commodity markets and learn how to trade long-short strategies, check our pinned comment and subscribe to our mailing list. Let's get into the video.
I mean, Tim Cook understands, and his board of directors understand, that if they want to maintain the credibility of the corporation, they have to maintain some control over the amount of shares they issue. And the same is true at Microsoft, and the same is true at Google. They may print more equity, but it won't be ungoverned and dysfunctional. But imagine there were 100 companies called Apple, and they could all print Apple stock. And people want Apple stock. So maybe Tim Cook wouldn't, but the Apple competitor number 4 in Timbuktu, they could, and they could sell Apple stock. Well, in that case, they're all going to print as much as they can to drive the price down because they're ungoverned. And in fact, they have an incentive to sell the stock. And so that's what it's like in the commodities business. Somebody somewhere has an incentive to drive the price of that commodity down, and they will sell as much as they can get their hands on. And so that being the case, there's never been a commodity like Bitcoin that was scarce. The closest thing to something like Bitcoin would be acreage in Palm Beach or acreage in Miami Beach. Not the square footage, but rather the underlying dirt. Because there's only so many linear feet of beachfront property in Palm Beach for the last 100 years, and no amount of money printing, and no amount of capital, and no amount of technology, and no amount of manufacturing know-how creates more beachfront property in Palm Beach. So when you look at that scarce, desirable property that you can't create more of, you can see that actually does go up in value. That's gone up by a factor of 1,000 in the last 100 years, 1,000x. And that appreciates at the rate that the money expands. But the problem is, it's not a treasury asset. I can't buy and sell square feet of Palm Beach every day in the market. I can't liquidate it on demand. So the kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred. And so what you've got is you have the opportunity, if you're Apple Computer, to buy $100 billion worth of an asset, which will appreciate 15 to 20% a year with no tax load. So you're picking up a $20 billion shareholder gain as an investment income, right? With a very favorable tax treatment. And what's the second best idea? Well, the second best idea is I allocate 10% of my treasury to the S&P index, and I don't get the 14% gain. I get a 7% gain, and I can't ever have more than a small amount because otherwise I'll trip those SEC covenants. But that second best idea isn't all that compelling because the institutional investor looks at that and says, you could have just given me the money and I could have put it in the S&P index. So you're not really doing anything I can't do. and you're not really getting that much of a yield. You're not using any strategic advantage that you have in order to generate something in excess of the S&P return. So fair value accounting opened the door for Bitcoin to serve as a treasury asset for an operating company. And the first order action of that would be, I'm a CFO and I start to allocate some of my capital from treasury assets to Bitcoin. Maybe instead of 90% treasuries, 10% cash, I go 10% Bitcoin, 80% treasury, 10% cash. And then, of course, maybe then 20% Bitcoin, 70% treasuries, etc. So we start to see a creeping up of allocation from treasuries to Bitcoin. But the second order effect, which is a much more profound effect, is to basically turn the entire theory of treasury management on its head. Instead of dispersing all my cash flows to my investors via buybacks, instead of buying my stock back, I buy Bitcoin. Instead of doing acquisitions of other operating companies, I do an acquisition of Bitcoin. Instead of dividending out my cash flows, which generates a taxable event for my investors, I actually buy Bitcoin, which is tax-deferred asset appreciation for my investors. And I'm doing something for them which is beneficial to them because they can't necessarily do that themselves, right? And so that's a benefit to them. And I'm strengthening my core business because I'm putting a strong capital foundation underneath it. So instead of people worrying that I might get liquidated or I might trip a debt covenant, I'm now deemed to be an extremely well-capitalized company with a longer duration, longer time horizon, and I can invest the earnings from that balance sheet back into the core business, or I can use them for strategic acquisitions in the future or the like.
But first, like and subscribe to the channel to stay informed, and check the Bybit promo where you can get free $20 just for creating an account with no deposit, so you can start trading real money today.